Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're looking at two large cap stocks to consider buying ahead of earnings, and that is Adobe and RH. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we dive into Adobe and RH, I want to, as we always do, take a broader market overview and a look a little bit at the actual earnings season to give a better context for what's going on with Adobe and RH. So the S&P 500 has closed at multiple highs in that last week. So last week, as did the Dow, with the tech-heavy NASDAQ taking a pretty big spill last Thursday, but it's still trending back in the right direction after it fell into a correction, down 10% from its highs on March 8th. So since March 8th, it's been trending heavily upwards. The NASDAQ is now up 1.3% through morning trading on Monday, with the S&P 500 was up around 0.6%, and the Dow was up slightly as of the last time I checked. Overall, the earnings picture has remained the same, and the broader story of the market has remained relatively unchanged since the mid-February sell-off, with Wall Street still sorting out expectations for inflation. With that in mind, we have that latest nearly $2 trillion stimulus plan, coupled with the vaccine rollout and the already in progress economic bounce back, is leading to a massive wave of bond selling that's pushed treasury yields to their highest levels in over a year. This is where all these inflation worries are coming in. Jerome Powell and the Fed have not changed their easy money stance. So even with the U.S. economy projected to grow by 6%, which would be its largest expansion in years. So all of this is leading to these inflation worries that we've been talking about now for over a month in the market. But bond yields remain historically low, and this is going to create what is likely the continuation of there is no alternative investing. So that TINA investing we always hear about, and Wall Street is transferring some of their profits from the big tech winners like Apple and Tesla and countless others into more cyclical names from within finance and energy, as the economy is prepared to bounce back. That said, the NASDAQ is still up roughly 90% in the past year and 175% in the past 5 years to easily crush the S&P 500. It's a 100% climb over this stretch. So even if there's more near-term selling pressure and flows into reopening stocks, tech seems to be likely to remain one of the best longer-term investment areas. All right, so now we're quickly going to look at the broader earnings picture for 2021 and the first quarter before we jump into Adobe and RH. So far, our most recent Zacks data has Q1 earnings jumping about 19.4%, and this is up from our previous expectations for growth. If we look back to early December, we were calling for about 12% earnings growth. So we've gone up 7% in the last several months since the end of 2020. So trending heavily in the right direction. And overall, for the first quarter, we're calling for, as I said, 19.4% earnings growth on 5.3% revenue growth, and then trending even bigger for larger growth in the second quarter against those easy to compare periods with that first initial coronavirus downturn in the second quarter of 2020. So overall, our full year earnings for 2021, we're calling for 24.4% growth on about 9% higher sales. And if we look ahead to 2022, we're calling for another 15% growth in the top line, in 15% bottom line growth, 7% top line growth. And then in 2023, we're calling for another 11% growth and 5% sales growth. So we're calling for 3 straight years of rather impressive growth after a big downturn in 2020. So as we said, 2021 trending in the right direction, and we see that those first quarter estimates are continuing to climb since where they were in December. And now we're going to go ahead and start to look at Adobe, which is set to release its first quarter fiscal 2021 earnings results after the closing bell on Tuesday, March 23rd. So after the bell on Tuesday, and we're talking about Adobe, which trades under the ticker ADBE. Adobe is a company that invented the PDF back in the 80s, and it went public in 1986. Today, the firm's business focus offerings have expanded into marketing and commerce, to e-signatures, and more. On top of that, and it's probably much more famous for its subscription-based creative and design software that includes everything from Photoshop and Lightroom and InDesign and Illustrator, and those offerings go on and on. And they're regularly regarded as relatively irreplaceable by people that use them. Adobe's suite of creative software are relatively unique as well in a crowded cloud software space, and its customers range from large enterprises to schools to individual creatives and consumers. More recently, Adobe has rolled out creative software offerings for the digital media age, where high quality content and video is paramount across websites and social media and everywhere in between. People are just expecting everything you put out there to look great, especially in a world where online businesses are starting and selling things via social media and just their own websites and Shopify, stuff like that. So the firm also in December completed its acquisition of leading work management platform for marketers, and that is Workfront. So another positive addition to that business focused software. Adobe's Creative Cloud offerings also help provide a solid moat in these consistent revenue streams that investors are looking for. And the company is currently in the midst of an impressive streak of revenue growth. Adobe beat our Q4 estimates back in December with its 2020 revenue up 15%. This followed growth of 4 straight years of between 22 to 25% top line expansion after they did 15% growth the year prior. So, as we said, Adobe, which has been around for decades and decades, or not decades and decades, but it went public all the way back in 1986. So it's not like this is a new growth tech company, and they've been able to do 5 straight years of between 15 to 25% top line growth. And then looking ahead, our Zacks estimates are calling for its 2021 revenues to jump 18% to over $15 billion, and then climb another 14% in 2022. This top line outlook would extend Adobe's streak of roughly 15% or higher sales to 8 straight years, which, as we just alluded to, is really impressive for a company of its size and age. Meanwhile, Adobe's adjusted earnings are projected to jump about 12% this year and another 18% in 2022. The company also boasts a solid history of quarterly earnings beats. That said, the company's consensus earning estimates have remained unchanged recently to help it grab a Zacks ranked number 3 hold heading into its earnings release. The company does land B grades in our Style Score system for growth and momentum, and 10 out of the 14 broker recommendations that Zacks has for Adobe at the moment come in at strong buys. The company is also trading at a discount to its own year-long medians in terms of both forward earnings and sales, which is a solid sign, and the valuation appears to be a little bit more enticing based on the fact that Adobe is trading at a 15% discount to its early September 2020 records at around $457 per share. And this was as of morning trading on Monday, with it up about 3.5% Monday morning as well. So the stock was on a big run from those coronavirus lows, but since September has not done as much as trading at a 15% discount to those September highs. The stock has also bounced back recently after it fell into oversold territory of underneath 30 in terms of RSI. So on that relative strength index, it fell below those levels on March 8th when the broader NASDAQ fell into correction territory. Since then, it's popped back. Despite those recent resurgence from those March 8th dip, the stock is still at neutral levels in terms of RSI, which could give the stock that's outpaced Apple and Microsoft and a bunch of other huge tech names over the last 5 years still plenty of runway left. And all of this might make Adobe a long-term stock to consider, as with considering any stock directly before an earnings report. If you're buying it just for that post-earnings pop, you never know what's going to happen. Wall Street could sell a stock even though it had a great report and solid earnings and solid guidance. You just never know. But long-term, buying Adobe at a 15% discount with all of its growth and all of its ability to continue to grow in its offerings that are relatively unique. As we said, those creative offerings are not really found many other places, and it's been a stock that's been on a tear, and it's continuing to grow at a rapid pace, which is really impressive, as I said, for a company that's been around for so long. But once again, if you're buying it just around earnings, you never know what's going to happen. But at a 15% discount for Adobe, it's good long-term setup at the moment. And now we're going to move on to a totally different stock, but another large cap name that's set to report their results later this week, and that is RH. It trades under the ticker RH. It's formerly known as Restoration Hardware. They've gone to a more sleek sounding name, I guess you could say, in just RH. And they're set to release their fourth quarter fiscal 2020 financial results after the market closes on Wednesday, March 24th. So on Wednesday, with Adobe set to report on Tuesday. So RH is a high-end furniture and home decor stock that skyrocketed over 400% in the last year. This helps destroy fellow coronavirus stars such as Shopify. And this is as Wall Street is clamoring for home-focused stocks. RH, as we mentioned, it's a high-end furniture and home decor powerhouse. It's grown at its revenue at a solid clip since its debut on the public markets back in 2012. And what's relatively interesting is that RH is still focused on its catalogs and going big kind of and zigging while other companies are zagging. It's also improving its e-commerce business, and it's been able to grow while other more legacy companies such as Macy's have struggled overall. The California headquartered company has gone bigger, as we mentioned, opening massive luxury-focused stores with accompanying bars and restaurants in major cities from Chicago to New York. Over the last several years, the company is also trying to expand its international business. And Wall Street investors were really pleased to hear over the summer about the possibility of expanding even beyond retail. Its chief executive, Gary Friedman, teased its plans to enter the housing and hotel market in a letter to shareholders over the summer, where he said, quote, "Our hospitality efforts will continue to elevate the RH brand as we move beyond the four walls of our galleries into RH guest houses, where our goal is to create a new market for travelers seeking privacy and luxury in the $200 billion hotel industry." He went on to say, "Our ecosystem will come full circle as we begin to conceptualize and sell spaces, moving the brand beyond the $200 billion furnishing market into the $1.7 trillion American housing market by offering beautifully designed and furnished turnkey homes and condominiums with the introduction of RH residences." This was a plan over the summer. There hasn't been that many updates on this since, but this could be the company's long-term goal, is to expand beyond those stores and get into, as he said, the hotel and the broader housing market, and Wall Street has loved to hear that. RH then in December beat our Q3 estimates with its revenue up about 24% for its best top-line growth in years. Zacks estimates now call for its fourth quarter sales to jump 20% to help lift its adjusted earnings by nearly 30%. The company's strong second half of 2020, after it was hit hard in the early months of the coronavirus, is projected to help its full-year revenue jump 7% to about $2.8 billion. And then on the bottom end, its adjusted 2020 earnings are projected to soar 50% and then jump another 10% each in 2021 for both earnings and revenue is what our estimates are calling for. So like Adobe, RH is currently a Zacks rank number 3 hold, with its earnings estimates remaining relatively unchanged recently. And like with Adobe, the company boasts a solid history of quarterly earnings beats, including a 30% average beat in the trailing 4 quarters. As we talked about a little bit at the top with RH, RH is part of the Zacks retail home furnishing space that includes the likes of Ethan Allen and Tempur Sealy and others, that sits in the top 7% of our over 250 Zacks industries at the moment. This comes as the U.S. housing market has boomed in 2020, as people also spend on various home improvement updates and home furnishing, which obviously RH is directly in that category. So last year, home sales hit their highest level since 2006. And looking forward, it's good to know that this growth could continue, since millennials are finally leading the charge in the housing market. So there could be more stability in this growth for years to come as millennials finally start to buy homes. And people, even though the coronavirus is slowly maybe becoming something that's not at the forefront of most people's minds as they try to get back to living something more close to their normal lives, there still could be this huge push for spending in the housing market, as we mentioned, with coronavirus living, where people are still maybe going to be working remotely and they want their house to look nicer. And then with millennials buying homes finally, that this market could continue to benefit RH. And we should note that the stock has been on a really impressive run. The stock soared 400% in the last year, and this is part of a huge run, like with Adobe over the last 5 years. The stock is up about 1,200% over the last 5 years. This crushes the S&P 500, Amazon, Target, its industry, and many other huge growth names. The stock did take a hit in early March, but it's already recovered those losses, and it's trading at new records. As of Monday, it was up 3% Monday morning to trade at about $536 per share. Despite this resurgence, the stock isn't in the overbought territory just yet in terms of RSI. Plus, its valuation is hardly stretched, trading at a substantial discount against its industry and right near its own year-long median in just above the S&P 500. So clearly, RH appears worth considering as a longer-term investment, just like with Adobe. Investors should also know that its fundamentals grabbed Warren Buffett and Berkshire Hathaway's interest last year when they took a position in RH, and 11 of the 14 broker recommendations or ratings that we have at Zacks are for strong buys of RH at the moment. As we mentioned, and it's worth stressing all the time, if you're going to buy any stock for a near-term gain, it's much more of a risky thing if you're looking to see a post-earnings jump, or if you're trying to sell it short for a post-earnings dip. Very, very hard to predict, but longer-term RH seems to be certainly worth considering for the next year or so, or even longer than that, as furniture is never going to go out of style, and it's worth considering as we head into its earnings on Wednesday. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.